Hello viewers, how are you? Today I'm presenting you a new video, and in this video I will be speaking about different ways to invest your money in different products, mainly with reference to Canada and the US. As you know, there are various products available in the market. You can have saving account, you can buy GICs, known as guaranteed income certificates, mutual funds, exchange traded funds known as ETFs, stocks, and of course you could also invest your money into. Your decision of selecting investment products is based on your nature of risk. If you are a risk-loving person, you would definitely go on to the stocks, buying individual stocks, and mainly those stocks that have potential to grow. But if you are a risk-averse person, you will be investing your money into either a GIC or in parking it into a saving account. But if you are a medium type person, who is willing to take some risk and not to lose the principal amount of investment, so you would prefer to go a part of your income into a GIC, a portion would go onto mutual fund or ETFs, and some part of your investment portfolio would be into individual stocks. And then in the stocks, you will also decide what kind of stocks you want. Do you want dividend paying stocks? Another big factor about in deciding your investment products is your age. A thumb rule is that take the number 100 and subtract your age from that 100. Suppose you are 50 years old, so taking the 50 out means that 50%, which is your age, should be invested into safe products, and the remaining 50% could go on to risky products. So safe products like GICs and saving accounts, or to some extent bonds, and the rest risky products are stocks, which includes individual stocks, mutual funds, and ETFs. And if your age is 60, so 60% should go on to safe product and 40% should go on to
this slide shows about the various products that can be offered in the financial market, including saving account, which has the lowest expected return. The reason behind it that the risk is zero for saving accounts. Once you have put your money into saving account, you are guaranteed 0.5 to 1% interest rate every year, and your principal amount is safe whatever the conditions are. Second thing is guaranteed investment certificates like GICs. The expected return is also low, between 1.75 to 2.5%, and the principal reason is risk is zero, your principal is safe. The difference between saving accounts and the GIC is that in GICs you are committed for a certain period of time to invest into that fund. It could be 1 year to 5 years. So that's why the return is a bit higher. However, what I want to mention here is that the interest that you receive on saving accounts or guaranteed investment certificates is taxable at 100%. So it means that if you get 1% return on your investment and you invested $100, you got $1 return, and you pay whatever your tax rate is income on that 1%, until and unless you are investing into a retirement saving fund or through your TFSA account. The third possibility is the mutual fund and also exchange traded fund like ETFs. They both are same. Banks, they establish a fund and then they generate money, and then they buy a bunch of companies share, and that's how by investing into that funds, an investor becomes a shareholder in that fund. The major difference between ETF and mutual fund is that the MER, which is known as management expense ratio, is very low for ETF but pretty high for the mutual funds. For example, a mutual fund MER could be between 3%, 2 to 3%, but for ETFs it is between 0.3 to 0.65%. So there's a big difference. However, there's a drawback in buying ETFs. Whenever you want to buy ETF, whether you buy one ETF or you buy 100 ETF or 1,000 ETFs, you are paying a commission to your brokerage based on your trade. So each trade, whether it is 100 or 1,000 ETFs, you have to pay that commission, which ranges from $5 to $9 or $10. But for mutual funds, you have to initially buy the fund with $500, and you can contribute $50 every month, a minimum amount. If you want to contribute, there is no charges. So that's a big difference between mutual fund and exchange traded funds. Now we come to the main point, and that is the stocks. As you can see from this slide, the expected return that you expect on stocks could be negative to very high, and I will show you in the next slide why I'm saying this thing. So the risk is very high as well, because you are investing into individual companies. All companies are individual companies, so each company can behave differently with economic changes that could occur in the market. So that's why the stocks are a bit risky, but greater the risk, there will be greater the profit. And finally, if you want to invest into real estate investment, that's a complete different story. In the recent past, many people have made their fortune investing into the real estate markets, especially in Vancouver and in Toronto. All right, so now we have decided where do we want to invest. Suppose we decide to invest into the stock market, whether buying a mutual fund or buying an ETF or investing into individual companies. It is important for us to know what happens in the market. You can see here the market over time grows, but with some hiccups. For example, during the 9/11 period, you can see that there was a sharp drop into the stock market. And then when the financial crisis happened in 2008, that we all know about subprime mortgage, there was again a sharp drop into the Toronto Stock Exchange market. And recently, COVID-19, and during the COVID-19 period in the 2019, there was a big drop into the stock market. So the point is that overall, the stock market grows, but there are periods when the stock market crashes. So be sure that when do you need money? If you need the money during the time when the market is crashed, you will be at loss, and that loss would be substantial. So for safety purpose, what you can do is, if you need the money in the next 3 to 5 years, keep that money aside. And that's why I said in the beginning that you need to invest into different types of products, safe products and unsafe products. So stocks are unsafe, but they're higher return, and GICs is safe. So when the market is down, you don't need to take the money out from the market, leave it there and wait for the good time. So here is a simple example of various products. Suppose you have invested $10,000 into saving account or GIC or a mutual fund or ETF. Of course, after 10 years period of time, your investment will grow only by $775 for saving accounts, $2,190 from GICs, and of course $6,895 if you would have invested into mutual funds. Now consider the stock market, and you have invested that $10,000 into an individual company. Suppose you have invested 10 years ago that $10,000 into buying an Apple stock, famous Apple stock. Today, after 10 years, your total investment would have been $60,228. This means you have made $50,000 of your $10,000 investment. Or if you would have invested that 10,000 into Amazon 10 years ago, your 10,000 would have been $130,000. However, be careful, everything is not rosy. We can have severe losses as well. For example, if we have invested that money, same 10,000 into an oil company like Baytex, today your value of your 10,000 would have been not more than $225. And if you have invested that money into another high-tech company like BlackBerry, your 10,000 would have been reduced to $1,350. Okay, now I just want to quickly show you how can you buy a stock from your brokerage account or from the trading account. Okay, so here is your account. This is a typical bank account. I have taken it from Scotia Bank. And suppose you have decided to buy a stock which is Bonterra Energy Company. What will you do first is by clicking this search button here, you will find out what is the symbol of this company. It is called BNE, and then of course the company is into the Canadian market, so it's called CA. If the company is in the US market, then it will be written US here. It also shows here what is the current price here is $1.19, and it tells us that what are the bids for this stock. For each stock, buyers are offering $1.17, and there are 20 buyers who are offering this price, and the asking price is $1.19. Means the investors who hold that stock are asking for $1.90, and there are only 12 investors who are willing to sell. So as a result, you can see that there is less people are selling, more people are willing to buy. So we see some increase in the value of the stock here. So for today's price, there is a 17 cents increase gain. So once you have decided to buy this stock, you simply go to buy, and then there are two options here. Either you choose market or you can choose limit price, and limit price is your own price, at what price you want to buy. This account is showing, I'll just put it hypothetically here, this is your account number, and it shows what kind of account is that. For example, is it TFSA or it is RRSP or your personal investing account. And it shows here how much cash you have in your account and what is your buying power. So that's how, once you do that, then you go and click this button of preview order. Once you have pressed the preview button, you reach to a second screen, and that screen explains you your preview order. So it's telling you that you are buying BNE in Canadian market at $1.19. So you are buying only one stock. So if you look at here, it tells you buy one at MKT, means buy one stock at market price. Estimated totals, they are offering you that principal value of your stock is $1.19. There's a commission of $9.99 in Canadian dollars. FX rate is foreign exchange rate. In case if you are buying in the US market, then you have to pay a foreign exchange rate. So because we are buying from Canadian market, there is no foreign exchange rate. And finally, there is a transaction value. So your total transaction value for this one stock is actually $11.18. Note, if you are buying one or you are buying 1,000, your commission remains the same, $9.99. Once you have looked into this, you are happy with it, just submit order, and then your order is confirmed. So thank you very much for watching this video. I will strongly suggest that if you like this video, please subscribe my channel and press the bell button, because there will be more videos coming in the future and you will be the first to watch them. You'll get a notification. Thank you again.